Hello, today we are going to solve October 2024 paper question number 2. Billick extracted a trial balance on 30th September 2024. He then prepared a draft statement of profit or loss and other comprehensive income for the year ended 30th September 2024. Prepare the journal entries to correct the errors 1 to 6. The narratives and dates are not required. So these are the inspection and he found the errors. The first one is the credit purchases of 1150 from Roth had not been recorded in the books of account. So the two accounts that's going to get affected. One is the Roth account and the other one is the purchases account. These are the double entry, so we will correct because it is not even recorded in the book, so double entry it would have not happened. So one is the purchases account and the other one is the Roth account. Okay, so in the Roth account this value is going to appear on the credit side. Okay, so with business had purchased, so it is a trade payables account, so this is going to appear on this side, and in the purchases account this is going to appear on the debit side. Then the inventory count of 30th September was understated by 900. So we can see that, so the two accounts that's going to get affected are the inventory account. Okay, this is a closing inventory count, and so income statement will get affected. Okay, so let's put that. So closing inventory, so closing inventory, okay, closing inventory, and then we have the income statement. Okay, so these are the two accounts that's going to get affected. Closing inventory, it was understated, okay, by 900, so you had to include more, okay, in the closing inventory, and in the income statement it will appear on the other side. So let's write that. So this is 900 closing inventory debit, and in the income statement it's going to appear as a credit. Okay, had to include more of the closing inventory. So then the leasehold on the buildings of 20-year lease, no depreciation had been charged. So we have to include this depreciation. So the leasehold building at cost were at 80,000. So which means that what is the depreciation cost? It will be 80,000 divided by 20 years. So that will be equal to 4,000, right? So 80,000 divided by 20, that is equal to 4,000. So that would be the depreciation cost. So let's include the two accounts that's going to get affected are the depreciation account, depreciation, okay, and then that is provision for depreciation account, okay, provision of depreciation account. Okay, so in that we have to include this provision, so it's going to be equal to 4,000. Okay, it's going to get increased, and this we will be transferring it to the income statement as expenses, so debit. Okay, then we have the purchases of a new computer costing 2,000 had been posted to the computer maintenance account. So here, what are the two things that's going to, so a vehicle, what is that, computer account, asset account, okay, new computer, so and maintenance expense, it has been entered in as an expense thing. So we have to remove from the computer maintenance, okay, we have to remove from the computer's maintenance account, and we have to enter into the asset account, okay, of the computers. So for the removal, the expenses would have appeared on the this side. Okay, so for removal you will go and put it on the credit side, so 2,000. Okay, right? So then this has to be updated in the, you can update in the computer, you can update it in the computers account. Okay, it's an asset account. So here you will have it on the asset side. Okay, then J Johnson, and then there is no depreciation had been charged on the computer, so this should also be included. So let's include in the provision for depreciation account. Okay, in the depreciation provision and income statement. So provision for depreciation for the computers we have to include 2000 was this, and so no depreciation, so 25 percentage of 2000, let's calculate. So 25 percentage of 2000, that is equal to, that is equal to 500. So we have to charge this. Okay, so for charging the depreciation, provision for depreciation, we will include it on the correct side as 500, and this we have to transfer it to the income statement as an expense of 500. Okay, so then we see that J Johnson, a credit customer, had paid 800 off the balance of his account in cash. No entries had been made in the books. So this was some cash that was paid by the a credit customer. He had paid off 800 in cash. So which means that you will have to, it affects the bank or the cash account. Okay, cash account. So which means that this person J Johnson's account we have to also update. He's a credit customer. It means it's a trade receivables. Okay, so these are the two accounts that's going to get affected. So a cash 800 has been received, so you will, it will come into the bank or the cash on this side, debit. Okay, and then you will have to also update in the J Johnson customers. Okay, then we have the allowance for irrecoverable debt balance should be have been reduced by 2000 on 30th September 2024. No entries had been made. So the allowance for irrecoverable debt was 2600 earlier. Now it is 2000. So we have to update this expense. So the allowance for irrecoverable debt account and the income statement, right? So income statement, so we have to update that as an expense. So this there is a decrease, so this becomes an, actually it acts as an income. Okay, so it is not an expense because there is a decrease in this decrease in expense, so which will be indicated on the credit side, and in the allowance for a recoverable debt it will appear on the debit side. Hello, today we are solving October 2024 paper question number 2, part B. Calculate the corrected profit for the year by completing the table after the correction of all the errors. If there is no effect on the profit as a result of this error, state no effect. Okay, so previously we had done a journal correction. So now let's see what is the effect of each on this, okay, on the profit. So here the first one we saw that for the Roth, okay, the credit purchases, so the increase in purchase would have happened. So we should remember, okay, so it's always easier to remember this. Okay, profit is equal to profit. If we open out the equation, we have revenue minus opening inventory minus purchases minus plus closing inventory, saying inventory, then minus expenses, right? So this is the after the thing. In this we can see that, okay, profit is going to directly related, okay, which means for two parameters it's going to be directly related. So one is the revenue and the other one is the closing inventory. What does that mean? Anything, if the revenue increases, profit will increase. If the closing inventory increases, the profit will increase. But for others it's going to behave inversely, okay. Any increase in one of them, like, okay, opening inventory, purchases and expenses, so the profit is going to get affected inversely. So this is another easier way to remember in the exam, because, okay, so that we can spare some time, okay. So the first one is, just look at this. First one is a purchase, so which means increase in purchase will result in, okay, increase in purchases will result in decrease in profit. I've already told this is going to get inversely related, okay. This is inverse relation. So the value is going to decrease the profit, 1150. Then inventory, this is closing inventory, so the closing inventory is going to increase. So increase in closing inventory will also increase the profit by 900. Then there is a leasehold, okay, of the building. This is an this is going to be like a purchase expense, okay, and you will only include the depreciation cost. So the depreciation, okay, so the this expense, this depreciation expense for the leasehold building, okay, it is increasing. Any increase in depreciation expense of 4000, it will cause a decrease in profit. So 4000 decrease. Then you have the new computer. The new computer, also on you have purchased 2000 has been posted to the maintenance. So maintenance expense is going to get reduced, expense decreases. So your, not because it's the purchase value, it is because the expense account, okay, increase decrease in expense account, I'm going to remove from that expense account of maintenance. So which means that it will lead me to increase in profit by that same amount. Then this depreciation, okay, 500 expense, it is going to increase the expense, so it is going to decrease the profit. Next, J Johnson, okay, he paid some cash. So it is paid off the cash in balance. So which means this person's account is not going to reflect anywhere. He's a trade receivables. So this means it has no effect. Okay, this is not going to cause any effect in the income statement. Then the expense, we saw that there is an increase in income, so which means other income, increase in profit, right? So that means by the same amount the profit is going to increase by 600. Now let's add up all of this, okay. So 1150, and then this one is 900, then this one is a negative, okay, it's going to decrease the profit. Then 2000, okay, I think you have to fill it here, okay. This one you need not fill up because they have grayed out. So let's just adjust all of this. So yeah, it's fine, okay. Then 2000 increase, so let's write that. Then 500 decrease, so this is going to result in 500 decrease. and then you have this as the no effect, then 600 increase. So if you add up, okay, the profit is going to be equal to, it's going to be equal to 9680. 9680. Okay, so the revised profit is going to be this much. So we can add up on this side it's going to be equal to 900 plus 2000 plus 600, it is going to be 3500. Then on this side 1150 plus 4000, okay, 4500. So this value is going to be equal to 5650. So 5650. Okay, so in the income statement you're going to add 11,830 plus 3,500 minus 5,600. That value is going to be 9,680. Okay. Hello, today we are going to solve October 2024 paper question number 2, okay, for Billick. Part C, prepare the statement of financial position at 30th September 2024 after all the correction of errors. So we had done some correction of errors. Now we have to start including all of them. So let's try to do that. So here we had to do the corrections before. Okay, first leasehold buildings. Okay, leasehold on buildings. So the cost is not going to change, so it is 8,000. So the cost is at 8,000, 80,000, sorry, the cost is at 80,000. And for the computer and fixtures, okay, there was a buying, so here we have to include for the computers and fixtures. Okay, actually we can also do the error correction and then proceed. So it is 26,000 plus 2,000. Okay, that is 28,000. Okay, let's correct all the errors and then proceed. Okay, it's easier that way. Then the inventory count, closing inventory was understated by 900. So if we see the closing inventory value was 100. So let's write that. So it will become equal to 100 plus 900. So that value is going to be equal to 12,000. Okay, so the inventory value is going to be equal to 12,000. So 12,000. Then we have this leasehold on the buildings. Then we had purchase of new computer costing 2,000, which we have accounted. Then the depreciation charge of 4,000. So the total depreciation is now going to become 30,000 plus 4,000. So 34,000. Okay, and then there was also a depreciation charge on the computer and equipment. So 500 was extra. So 9,800 plus the, okay, 9,800 plus 500. So that value is going to be equal to 10,300. Okay, so here there was two correction, one for this and the other one was for 9,800 plus 500. Then we can see that J Johnson, a credit customer, he had paid 800. So cash is going to get, cash and bank is going to get affected. So instead of 3,000, it will be now 3,000 plus 800. So the cash and the bank, okay, we have to update. So it will be equal to 3,000, okay, 3,000 plus 800. So that value will be equal to 3,800. And then this credit customer, so it is a trade receivables account. So it will get reduced. Okay, trade receivables is going to get reduced. So this is going to get reduced by 17,400 minus 600. So that value is going to be equal to, okay, that value is going to be equal to 1,400. One second. So 17,400 minus, he paid back 800, sorry, so he paid back 800. So it's going to reduce by 800. So minus 800, that value is 16,600. So it is 16,600. And we know that the allowance for irrecoverable debt had got reduced from this to 2000. So it will now become only less 2000. Okay, so this is less by 2000. So these were the changes. Okay, and so let's now start putting other things in place. So first one is, we have filled out, there were adjustments and errors with this. So let's calculate the carrying value. 80,000 minus 34,000, that should be equal to 46,000. Now 28 minus 10,300, so it is equal to 63,700. Now let's add up all of this. So 80 plus 20, 108,000. So is the total cost 108,000. 34 plus 10, 44,300. So this one is for 44,300. And this one 46 plus 63,700. So 1 second, this had become carrying value. So 28 minus 10,000, sorry, 28,000 minus 10,300. So that should be equal to 17,700. So it is 17,700. Okay, so this value is 17,700, and 46,000 plus 17,700, that value is 63,700. So this is going to be 63,700. So this is the total. This one is the current assets. Now let's non-current assets. Now let's calculate the current assets. So the first one is the inventory value, which we have put trade receivables and this one. So let's calculate this value. 16,600 minus 2,000, that is 14,600. Okay, so that was 14,600. General expenses. Okay, so what happened to the general expenses? It was around general expenses. Okay, 870 had got prepaid, so that one we have to put. So because it's a prepaid expense, it becomes an asset, so we put 870 here. And this cash and bank had got increased from 3,800. So let's add up all of this value. So 12,000. Okay, 12,000 plus 14,600 plus 870 plus 3,800. Okay, so that value should be equal to 31. Okay, 31,270. So 31,270. Now 31,270 plus 63,700. So it is equal to 94,970. So this is the value of the total assets. Okay. Now let's calculate the capital. So capital was 85,000. So let's put that. Okay, capital was 85,000 plus the profit for the year which we had calculated. Okay, profit for the year, it was 9680. So let's put that revised profit. So 9680. Now let's add up these two values. So that one is going to be equal to, so it is going to be equal to 94,680. Okay, 94,680. Now less the drawings. Okay, we have to reduce the drawings by 12,000. Okay, so let's write less drawings by 12,000. This had no errors. So 94,680 minus 12,000, that is equal to 82, 680. Now there were no non-current liabilities like loans. So let's calculate the current liabilities. First one is the trade payables. It was 8,000. Trade payables was around 8,800, and this also had some, okay, some effect. So let's adjust this. 9,800 plus 1,000, so 8,800 plus this one. Okay, this 1,150. So 8,800. Okay, 8,800 plus 1,150. So that value is going to be equal to, so 9,950. So it is 9,950. Then you had other payables like computer maintenance. Okay, other payables where for the computer maintenance, it had got accrued by 350. So let's put that. So accrued expense becomes a current liability. Heat and light also had got accrued. This is also an accrued expense. It was around 490. And then wages. Okay, wages had got accrued by 1,500. This is also an accrued expense which becomes a liability to the business. Now let's add up all of this. So when you add up all of this, you get, so 9,950 plus 350 plus 490 plus 1,500, 12,290. So it is 12,290. Okay, so it has added up to that. And then we have to find what is the total capital and total current liabilities. So just add up 82,680 plus 12,290. It should become equal to 94,970. So 94,970. So your assets and your liabilities has to get balanced. Hello, today we are going to solve October 2024 paper question number 2 part D. So evaluate whether the use of information and communication technology would help Bilek to avoid errors in his accounting records. So yes, there are certain positive points when he uses ICT. So and it will help him to reduce errors because it will help him calculation, mathematical calculation, okay, accuracy of calculation, processing large volumes of the data will avoid any errors, and it will also enable automatic double entry system, so it will going to avoid errors. And also it helps you to prepare income statements and reconciliations on a regular basis, and so it can do it very often it can be done, and so it can avoid errors. And it helps you to secure passwords so that only authorized person can amend the data or make changes to the data, so no errors can occur in the books. Then however, it there are some difficulties when using ICT. It could still lead to errors, like when a human is input the data, it could lead to errors. The data itself is wrong means it will go wrong. Then secondly, he has to bear in mind that it requires training of the staff and reskilling of the staff, because otherwise it will cause errors if they don't know how to use it. And the second one, it will include some cost for installing this software, and still certain errors like omission errors and errors of original entry cannot be identified or reduced by using ICT. So in conclusion, it is better to use ICT to avoid errors, as it enables the business to process large volumes of data automatically, and so it can reduce a lot of human errors